Thanks, Marty. We'll cover all of that. But let me start by introducing the panelists we have today, who are honestly outstanding. I'm so looking forward to hearing what they're going to tell us today. And Marty, thank you so much for introducing me. Olga, I can see that you are there in person. Hi. Let me start with introducing you, and then Ankita, and then Dan. Olga Serhiyevich is the head of investor relations at Village Global. It's an early stage VC backed by the world's leading entrepreneurs. And then the rest reads like who's who. It's Mark, Bill, Jeff, Sarah, Reid Hoffman. I'm just omitting the last, it's like Madonna, you know, at this point. Everybody knows them. And of course, some institutional investors, such as endowments and sovereign wealth funds. Olga, welcome.
Thank you.
Also with us is Ankita. Ankita, I hope that I don't mispronounce your last name. It's really, really hard to pronounce your name.
No worries.
Vashistha, right?
Yes, that's fine. Yes.
Oh, thank you. Okay. Ankita is the managing partner at StrongHer Venture.
Yes, StrongHer Venture.
It's a very, very cool name, I have to say.
Thank you.
And it's an early stage venture fund that's focused on women-led and focused companies across fintech, future of work, health, consumer, Web 3.0, and it invests across US and India and other select global locations.
Correct.
And then the perfect gentleman in our midst,
who's the only one.
Therefore, absolutely perfect, is Dan Gatti, who's the managing partner at Innovative Capital Ventures. And he doesn't just have one job, he's got two jobs because, and he'll tell you all about it, because he doesn't just have all the fun investing. I don't know why venture people seem to have all the fun in the world, I swear to God. He's also an operating partner, and he actually understands the businesses and goes in and runs them. So that's amazing. Dan will tell you all about their investments, but the focus is on edge, cloud technology, data analytics, cybersecurity, SaaS solutions for the enterprise. And that's the introductions. I would love for us to go in the same order, if you could, and tell us something about how your experience has brought you to where you are today, because I find that everything that we've done informs so much where we are. And you have such interesting bios.
So I'll start. Good afternoon. Good afternoon, everyone. Marty, thank you so much for inviting me, and Arthur for connecting me with Marty and the group. I'm Olga. I am the head of investor relations at Village Global. We are an early stage VC fund. And in terms of my background, I grew up in Belarus, moved to the States for college, spent most of my career in what in venture people refer to as TradFi. Someone earlier was talking about CDO squared. I started my career in structured credit at Morgan Stanley, worked at PIMCO, and then came to venture about 5 years ago. And Village Global is a network native VC fund. Everything we do is based on the network, which means that we spend a lot of time not only thinking about how we build our networks, but also how we can incentivize different parts of the network with capital and decision-making authority to scale everything that we do. And specifically in my case, I've always found the problem of human professional networks of how to scale them, how to leverage them to be one of the most interesting business problems in the world today. So Village was probably one of the best places to be the practitioner of that art and thinking about networks in that perspective. And I joined about a year ago. It's been a great journey so far.
Thank you, Olga. Ankita.
Hi, everyone. I'm Ankita Vashistha, founder and managing partner of StrongHer Ventures. Thanks, Marty, for having me here. I run an early stage venture fund to invest in pre-seed to early stage companies that are women-led and focused across US and India. To give you a very quick background, I've lived and worked across US, UK, India, Singapore, engineer who then kind of went into the world of finance. Starting my career in private equity in 2007, I used to work for Oreos Capital, which was at that time a $2 billion fund focused on the emerging markets with cornerstone investors like DEG, FMO, Norfund, CDC, et cetera. I was in their London office, and I was very lucky at very earlier on to be able to work very closely with the leadership team and learn across the functions of the fund, both on investor relations, portfolio management, of course, IC decisions, et cetera, and saw 2 of their funds exit out, saw 3 new funds being raised. Did that for 5 years, loved it. Then the engineer in me came out and I said, I want to see what's happening in emerging tech. I kind of moved back to Asia and I said, let me discover venture capital. And that's when I kind of started angel investing and making investments. I basically got investors to co-invest along with us and made a bunch of B2C and B2B investments in India, Singapore, Philippines, and the US. Also co-founded an accelerator called Wavemaker Labs in Singapore, which is one of the first accelerators to get funded by the Springboard in Singapore. So made a bunch of notable investments at that time. So one of my investments is Uni4 here in the Valley. They're now $2.5 billion in the conversational AI space. In India, we invested in Licious, which is last year became India's first D2C brand to become a unicorn. And from the accelerator, we made a few great investments. And one of my notable ones was a company called Luxola, which actually became Asia's first online cosmetic store. And we sold it to Sephora. And it was run by Alexis, a second-time woman founder. She went on to head Sephora Southeast Asia. And that's kind of what has brought me to where I am today. That's when it came to me and I said, why don't we have more women entrepreneurs in the ecosystem like Alexis? And whatever years I had been in PE and VC, to be honest, I didn't see many women in VC. And I saw that being a reason why companies weren't getting funded, right? So I said, this has to change. So around 2014, 15, I launched one of the first early stage venture funds to invest in women entrepreneurs. And my goal was basically to set up a fund and a platform where women can get access to capital, networks, community. But through our fund, we wanted to engage and empower more women as entrepreneurs, as employees, and as consumers. So I set up a $12 million fund. So I raised money from HNIs, family offices, and institutions between India and US, invested in India and US in B2B, B2C companies across tech-focused companies. That fund has done now very well. We've had 5 exits and multiple up rounds. As of last year, I said, let me take this more bigger and global. So now I've set up a fund here, both in the US and in India, to invest in pre-seed companies, women-led, women-focused. And we've narrowed down on sectors like fintech, future of work, health, consumer, and Web 3.0, because we believe these sectors enable women to get back into the workforce and allow them to be independent and successful creators and consumers. So that's what we're building out. So very passionate about female founders, but also bringing the entire ecosystem together where women and diversity-focused individuals can be involved as mentors, advisors, venture partners, and as investors.
Fabulous. Fabulous. Thank you so much for the intro. Dan, you're next.
Yeah, wow, a lot of women. I'm the only old man in the group here. I still deal with those old men, so I'm different. So I've been around a number of years. Innovative Capital is a unique, I'll call it boutique fund. We have corporate investors, and we look out for enterprise solutions for them. We're mostly focused on B2B, SaaS type of applications, mobile edge computing, multi-cloud environments, cybersecurity. Also what I'll call data applications that you can sell data, especially embedding data into the workflow. I usually explain the embedding data into the workflow very simplistically. I'm in San Diego, and they have all these trucks that go up and down the beach picking up garbage. So just think you had a sensor in that big tank, and the driver's driving by, and it gives a notification that it's empty, so go to the next one. So essentially, increasing productivity by embedding data into the workflow is very key, especially in today's environment with the supply chain and distribution to improve the productivity. That would be a big deal. Also with data analytics, and then also high performance computing, especially with analytics and machine learning. The more you have to provide those applications, you need high performance computing. And it's very expensive to combine NVIDIA processors with storage and communication. So you need a platform that can be transferred to all those folks. We are kind of unique because we're all ex-CEOs, so we're operating people. I've done 6 startups, 3 as a CEO, sold 1 company to 3Com a while back. And we get involved in helping from an operational point of view, but our real focus is partnering and go-to-market strategies so we can help companies scale. I mean, today, getting to new customers is a challenge for anybody. In the COVID world, it made it more difficult. So you really need introductions, and we work on our personal network, which has been around a long, long time, to get our companies in front of the right players in the tech companies. Yeah.
Dan, just to follow up on what you just said, and Olga, I'll ask you a very similar question in a second. What roles do your partners play in your portfolio companies? Do you literally take over as a C-suite and for a period of time? Can you step in?
No, we don't. We don't do that. We're trying to be more of a not just a board member. We don't want to take over. We want to work with them and trying to help them on the strategy and introduction. So it depends on the role. Sometimes it's lining up the right people from a development point of view. Most of the time, though, it's on helping scale from a go-to-market point of view, where we make introductions to the companies and we get involved in that kind of a process. But it's really helping them. We don't want to run the company. We want them to run and take advantage of our contacts and connections.
Got it. Okay, thank you so much. Olga, what is unique about your firm's approach to sourcing companies, investing in companies, and how hands-on are you in terms of your participation?
So we are a network native firm, and that means that everything we do is based on a network approach. I'll explain what that means in practice, but we think in early stage, and we focus at pre-seed and seed. We're a generalist fund, we're global. China is the only geography where we're not active, but in general, in early stage venture, the biggest challenge is discovery and sourcing. So you want to be able to see as many relevant companies as possible, but then, it's become easier than ever and cheaper than ever to start a company. So there's a lot of them. And so then a part of what you do as a manager is look at as many companies as you can and identify the ones that are more likely to be those $1 billion plus outcomes in the end. And our approach, and so because of that, sourcing becomes an incredibly important part of the strategy. And we source in a number of ways. So the first one is we work with about 24 of scouts. We call them network leaders, and they are angels, operators, former GPs, and other people who tend to be first call angels. So these are the people who get a call when a promising founder just starts to think about their next idea. And here you really want to be searching for the people who are the first ones to get that call, because they can shape how the round is going to look like. They can shape a lot of strategic decisions at the beginning of the company's life versus people who can squeeze in, $25K check at the end. Mm-hmm. So we try to identify those individuals and partner with them. We share GP carry with them, and we give them access to our network. And it really helps us to cover a lot more sectors. Most of them are sector specialists, and identify opportunities which we couldn't ourselves. It also helps us to diligence opportunities because of their expertise. And it helps us be very agile. Sometimes some of the best company opportunities might come from a certain, company alumni base, right? When we were starting 5 years ago, it was all about Palantir alumni. Then it was Stripe, then it was Coinbase. And so when you have this structure of working with scouts, you can partner with people who are more likely to see a lot of those types of deals and then shift wherever you see opportunities go. So it tends to be very flexible and helps us to cover a lot more sectors and geographies than we could ourselves. And it also helps us to support our companies after the investment in very specific ways. The truth is, even if the GPs at the firm have been, founders, builders before, that experience becomes outdated very quickly. And so when you have a group of, 25 or so people who are executives at high growth tech companies today, they see all of these challenges. They can actually be really helpful to entrepreneurs with very specific problems that they face. So that's the first part of the strategy. Then, as Julia mentioned, we are fortunate to be backed by a lot of top entrepreneurs who sort of built the world of technology today. And so we get a lot of referrals, either from some of our luminary LPs. I believe one time we got an email from Jeff Bezos. I did not know if we ended up investing in a company or not. It doesn't happen that often. But where it does help us is the brand, and we just get a lot of inbound because of the brand and being associated with these tech founders. And the last one is founder referrals. So we are very focused on creating a large-scale founder community, and founders find it helpful, and so they start referring some of their friends to us, and that is the basis of our sourcing strategy. And just to quickly address the value add part, we have a broad portfolio, and this is one of those things that is actually supported in data, that at early stages, broader portfolios tend to outperform concentrated ones, but it tends to be one of the most contrarian ideas when you actually talk to a lot of LPs. But we have a broad portfolio and a lot of portfolio companies, so we have to be very careful with areas where we decide to provide value add. We just simply cannot scale it. And so where we are very involved is in helping our companies connect with the best investors for their next round after us. We spend a lot of time facilitating those introductions and help with the fundraising strategy. And then the other part of it is really providing access to the network, whether it's scouts for specific strategic advice, whether it's the rest of the founder community where they can share, best practices and whatever they're facing. But basically access to the network is our other value add. And this is really where we focus.
Wonderful, thank you. My next question is a two-part question, because I can ask it very broadly, as in what are the main trends today? But I think Marty kind of gave away the non-secret of the valuations being one of the things that we talk about the most as far as the current trends are concerned. So I will leave it up to you how you would like to talk about this. So major trends, and what do you think about where the valuations are today? And do you have any thoughts on where we're heading?
Yeah, I think things are changing tremendously. I think Marty's question is right about venture capital today. Most companies are not looking to invest in startups. If you don't have revenue, you're not close to profitability, it's kind of time to take a step back and look at what you're doing. We're changing our focus. We're looking at, you almost have to be profitable, if not profitable. And we look at how we can scale those companies. So we're not looking at any early stage anymore. It's great to have, good vision, good ideas, but until you have real customers that are paying and that the revenue is scaling on a monthly basis, we're not going to be interested. So our approach now is going after solid, real companies.
Yeah, I mean, just to add on over here, very similar to what Dan said. I think, last year, like few months and years, we kind of saw a very high valued founders market. I think what's happened over time because of what's happening in the public markets, what's happening in the economy and in the world right now, things have got shook up. And I think sustainability, profitability are key to kind of scale up, right? So I don't think, people are telling, go out there, spend money, build out that community, do all that, that's fine. But I think it's really important to have monetization and revenue in mind as well. keeping sustainability and runway, right? So even for existing portfolios, from a VC perspective, we're asking everyone to rethink their strategy, their go-to-market. What is their plan B, given what happens out there, right? And I think that is anyway the real way to build a business. It just so happened that, of course, when there's this peak in the market, there's so much money out there, there's so much money to burn, we sometimes lose sight of that, right? But I think there's a lot more, focus going forward from that perspective. Also, I think in the VC world, and just one more trend that I've seen is, of course, I know, we saw so many companies going public, IPO, SPAC last year. And of course, the year before that, that's going to definitely reduce now, going forward. People will have to rethink their strategy, because not only in the US, but in India as well, most of the companies that went public last year, today, they can be, they've lost their value anywhere from 20 to 60, 70%, right? So those valuations, of course, again, so I think valuations at all stages have been affected from that perspective, right? So I think that is something that we'll look at. But I think the good thing out there is that there is dry powder in the market for good companies. So I think VCs will be reserving that for the existing portfolio and any new companies that they think deserve it. Also, a lot more money probably will flow into pre-seed and seed in that sense, because I think they want to see what's coming up, what's happening, and kind of backing that, then seeing, because I know so many late stage companies, their IPOs have been kind of delayed, right? So things around that. And of course, there's certain trends in terms of sectors we can talk about. But of course, I think fintech, and I think maybe you can also talk about it yourself, saw so much money going in, right? Fintech, healthcare, etc. But yeah, so definitely so many trends we can definitely compare from last quarter to this quarter.
Wonderful. Thank you. Olga, any thoughts on this?
Yeah, just to add a little bit, the truth is that in pre-seed and seed markets, but specifically pre-seed, valuations actually never went up that much in the last few years. What changed was the pace of deal making, where everything just became much faster than it's been before. And but the valuations went up a little bit, but a lot less than I think at some point I saw something from AngelList where it showed Series A valuations were up 25%, Series B maybe like 30, 35, but at seed and pre-seed it was probably closer to 10% or so. Now the truth is, for pre-seed seed stage manager, if you actually do the math and look at your portfolio construction, it's extremely sensitive to what your entry price is. So even that slight difference is still important, and that was something that we remained extremely focused on, making sure that our entry price stayed anchored around 10 million post, which was very difficult in certain sectors such as Web3, where many of these companies, come to the market at 50 post and so on. It hasn't been the easiest position to maintain in the last couple of years, especially as many managers started to assume that, your exit price, 10 billion, 100 billion is the new billion, et cetera, right? There's been a little bit of inflation, but anyways, pre-seed and seed just never moved quite as much, but it's starting to adjust. And the big threat to our part of the market last year was from crossover investors who started to become more active in early stage, either through fund investments or direct investments. But as we're all aware, their attention is now elsewhere. So that sort of went away. And of course, there are some sectors which will have a lot of sensitivity to the general macroeconomic conditions, where it's going to be a lot more difficult to launch a company and get capital. But the biggest constraint that we saw and we still see for the companies at the stage where we invest is actually around talent. And so this kind of market, where a lot of large tech companies have been laying off people, where stocks are way underwater for what folks may have held them on the books, it starts to become easier for early stage companies to hire the best talent. And we've seen that to be the biggest constraint to their growth and potential, rather than the capital. And that's starting to improve now. So we are cautiously optimistic.
Hey, let me add something to what Ankita said. The flexibility. Flexibility is key. If you even go back to some of the great superstars like Cisco changed their whole strategy, right after year 2. So being flexible today is really important. And we're looking at, I'm saying to all of our companies, what real pain points are you solving? And what are they paying for it? If they're not paying to solve a pain point, you don't have a solution. So go back and look and reevaluate that. Don't get comfortable with what you have today. Make sure it's got long-term capability and be flexible. Also, look at your staff. Can you eliminate people? I mean, right now you need powder, and I think it's going to be a tough environment going forward until you really become real business people and look at the business economics.
I had a question, Julie, if I can just interrupt for a second.
Yes.
So I know that a lot of people are saying these crossover investors are not, in the market anymore, but what percent of these crossover investors, I mean, none of them were lead investors, is that correct? They were all co-investors on these deals. So isn't venture going to then have to search for more co-investors? Any thoughts? Any thoughts? Right, because I mean, if a hedge fund was a co-investor and now they're not available anymore because they just blew up, then they're gone.
Yeah, so there's a bit of a difference whether they invest at the same stage with you. And, generally speaking, the thread there was that if they come in with a much higher valuation, because at pre-seed and seed, valuation generally is very much anchored by Y Combinator valuation. So they've sort of held that market anchored. And if you had large players come in and start throwing term sheets sort of magnitude higher, that would have pushed the market probably. So that, they're no longer playing in this market. So that threat is gone. Now, if your question is about follow-on investors, and if you're
Series
saying
B, sure.
it's great for us when Tiger was marking up our companies, that is very much true, but there's still a lot of dry powder in the market. The reality is that fundraising for funds has been extremely strong, and we don't yet have the data on sort of Q2, Q1 of this year, but it remains quite strong. And so many large mega funds have been raised that even if crossover investors start to become slightly less active, maybe we'll just have slightly more sane valuations, B, C, D onwards, but there's still a lot of capital to lead. It's just going to be different types of investors and maybe more focused on fundamentals, to Dan's point.
I wonder how much of that mega funds are closed or capital on call.
I think I think you're right, Marty. You're absolutely right. It's really about business fundamentals again. If you have real business, it's okay getting money. You don't have real business, it's real change. So,
right, because I mean, if a VC says, "Well, you got to give me your capital now," and the market has tanked and there's no buyer, the VC, the family office is going to say, "Great, sue me," right? And then ruin your reputation as an investor because your LPs are being sued by you. Right?
So I think this is an interesting point, and this is something we talk about a lot. But there's a big difference in the types of LPs that are active in the market, right? And so as a fund manager, you always want to have a diversified LP base. But if many of your LPs are sovereign wealth funds, endowments, and foundations, their decision-making processes are quite structured, right? And they're very long-term in nature, and you just don't see, Princetons of the world not contributing capital as committed. So I think some of those investors now, they've sort of had a different challenge in that their managers have been coming to the market much more frequently, raising bigger funds, etc. But generally speaking, if they committed, they are probably good for the money, right? With family offices are actually very opportunistic. And what I'm hearing from a lot of folks I talk to, they're like, this is a great market to buy a lot of high quality assets. Now, I don't know if you're all buying them directly, and that is possible. And in general, family offices are just much more agile, right? So I can see that they might decide, there's a ton of great opportunities elsewhere, and venture may not be it. But this is where diversified LP base, I think, is very important. And most of the folks who raised 5 billion plus funds probably raised them from sovereign wealth funds and endowments. And I don't know that there's that much difference there. Where there's going to be a lot of challenges in our part of the universe, solo GPs and subscale funds became an incredibly important force. And many of them literally raised capital from folks who invest through AngelList. So I would imagine that kind of LP base is going to be not participating, but in terms of total dollars, that wasn't as much of a market.
But just to add on here as well, so I agree with your points, is that, for example, all the bigger funds now will open up their allocation, to pre-seed and seed deals as well, right? Of course, I think the late stage investors, kind of the division between that will change. But I think especially in early stage, what will happen is so many of these bigger funds are coming into early stage. And as you rightly said, family offices are finding this as a great opportunity to come in earlier into deals and get at them at a better valuation. It's the same trend we're seeing in India as well, where you're seeing so many more family offices, so many more ex-founder-led funds now as well, because such great exits have happened in the ecosystem. So a lot more, I think, powder available for early stage. Of course, late stage, it's going to be a little difficult. But yes, so many more opportunities out there.
So do you think family offices are incredibly amazing co-investors?
I think they're a great source when you're kind of looking at, early stage Series A, Series B, because they don't necessarily have such long cycles. They're more agile, like Olga said. They have the dry powder available. It depends if they're strategic or not. But I think that they're a great kind of investor to come in, at the Series A, B, C rounds. Yeah.
Great. I want to go back to something that Dan brought up. And when you talked about COVID and the fact that, companies needed more in terms of introductions, it's much more difficult to get the doors open. So what other impacts, other than nobody wants to go back in the office, what other impacts of COVID have you experienced, have you seen in terms of the startups? And do you think we are out of the woods yet in terms of the impact of COVID, or are we still on the long tail of that?
I think the biggest issue with COVID is that all the networking events got canceled. And even Marty's event, which I used to go to all the time, I haven't gone to. And the second part is we've all got used to Zoom, so you become lazy. Instead of making the trip, you'll do a Zoom call. I mean, it just seems to me all of the marketing, networking, those type of events have disappeared for the most part. And even when you have them, you don't get the participation in person. And that's where you establish all these relationships. So for a new emerging company to establish relationships without meeting people in person, it's difficult.
Yeah.
Yeah, I agree with you. And, of course, we always talk from a very female founder perspective. I think historically, we've always lacked access to capital and professional networks for women, right? So in instances like this, when everything is closed, I think it's even more difficult to build that first relationship. Of course, the world is now flat in that sense, and you can zoom in from anywhere. And I think ongoing relationships can be maintained, but it's really key to meet in person, I guess, to kind of really make that impact and kind of raise capital and go out and get business. And of course, travel itself was very limited, right? So many people couldn't cross over unless they had the relevant visas, etc. So I think that definitely happened. I think hiring and talent was also kind of very impacted. And of course, what happened over time is, I'm just again talking from a very US India perspective. So many times before, we had companies building here in US who were very easily be able to hire much better cost and much better talent, say in kind of other locations. But because everything went flat, salaries actually all kind of also went on par. And so there was no cost differentiation in that sense. And I guess, it's very difficult to find talent because people are able to give very low kind of, notice periods, get new jobs very easily from anywhere. So even though I know it's a huge opportunity for people to work from anywhere, from a kind of employer's perspective, it gets very difficult to retain talent and also kind of maintain your costs, especially in a market right now where you have to rethink everything, right? So you have to really rethink your hires, what could be possibly automated, what is core, what can be kind of offshored. I think it's important to think around that. And I think technology, of course, so we anyway always invest in kind of tech-focused and tech-enabled companies, but I think all businesses have gone online, virtual. Technology is a key enabler, right? So I think you have to rethink your business and your kind of your product stack out there.
We see the same, when we say agile business model or agile tech, we don't get blank stares any longer. People are really listening to that. Olga, do you have anything to add?
No, I think this has been great. Thank you.
Okay, great. Let me see. A question from Marty. Hello?
Yeah.
Marty? Yeah. Sectors?
You can read it.
What sectors are the best to invest in today?
I mean, so from my perspective, I think I'm seeing a lot of companies, of course, like I said, in fintech, healthcare, anything which is able to kind of, we are now in this whole digital world, everything is online. So I think anything that can be accelerated by technology and is much needed will definitely be a great sector. I know everyone is looking at EV, clean tech, right? That's a huge space because that's kind of the future of work and life. So definitely all these sectors are, in kind of focus. And I think, yeah, just to talk from a diversity perspective also, I think it's really nice to see that diversity is also on the agenda. When I started my first fund 6-7 years ago, no one was necessarily talking about it. But because of COVID, and of course, things happen over here in terms of, the whole BLM movement, people started realizing the importance of inclusive leadership and inclusive, products and services. So I think diversity and ESG as well, right? So people are being made to report and think about sustainability, right? So I think all these are kind of the trends right now, and hopefully they sustain. Yeah.
Yeah, one area that I think is a huge problem is I'll call edge to multi-cloud. And in any enterprise making acquisitions, they're going to inherit a different cloud environment. So when you have a Google, you have Azure, you have AWS, and then you have applications that have to be upgraded that you've had for a long, long time. So in a big enterprise space, edge to multi-cloud with cybersecurity issues and ransomware becomes a huge problem, and being able to maintain security and also who's at the edge and how they're going to get into a different application on a different cloud is a big problem today.
Dan, can I just make a comment? So a phenomenal article, and I don't know where I can find it, but I was reading that 70% of municipalities that have had ransomware have paid it. That's amazing.
Yeah, well, of course, they've got old software. They haven't been maintained. They don't have the staff to do it. So now comes the change, and you add some new application on a different cloud environment. You got a huge problem, and ransomware is rampant.
Here's a good one. Try the DMV.
Yeah. Yeah.
Right.
Yeah.
Right. There you go. Right. So, but I mean, what I'm interested in, and I think there's a lot of interesting solutions in the edge and cloud, because we got a guy who says that he has like a ring, like a wearable device that has 5 terabytes of data storage. So nothing goes on the cloud at all, because it's just something that you have access to yourself and it's your own personal device, and you can back it up at home, et cetera. So it's kind of like the equivalent of like a cold wallet, but it's just your personal data. But it would really be great if our speakers could talk about the economic size or market size of what they're looking at, because like I know that Web3 is like, somebody estimated 700 billion, et cetera. But and there's not a lot of Web3 VCs out there, by the way. So it would be really great if you guys could talk about, well, I'm looking at this market because there's a lot of green fields, and we think that there's going to be good deals coming out of a $500 billion marketplace. So, and Dan, maybe you can do that and talk about where you're at, in terms of market sizes and marketplaces.
Yeah, but the problem with that, Marty, is it still hasn't proven yet. So I mean, I'm more basic. I mean, if the dogs are eating the dog food, we're interested. If they're not, we're not interested. So they could be hungry, but we need to see real revenue and real applications. I mean, I think it's going to happen, but it's right now it's just too risky.
Yeah, that's been a big problem with AI, right? Is that the dogs don't eat the dog food a lot of the time, right?
Right.
So
they just want to wear the servers. You know what I mean?
Yeah.
It's a wear the server on your leash. Okay. There's a question from the audience. Are you looking closer at growth and path to profitability in a world where money actually costs something? Or is it less relevant to you at the early stages? So in a world where there's interest rate is greater than 0.
Well, we're not involved in early stage anymore. You have to have customers and profits.
Okay, so it's true everywhere. Yeah, any stage. Olga, a question for you. What would you recommend to LPs that are interested in direct investments?
So someone mentioned earlier that family offices could be great sources of capital for co-investments, and we certainly see a lot of interest from our LPs. I think there's a couple of things there. One is, I think it's very important to start by, if you're in the early days of direct investing programs, to start by building a relationship with GPs through investing in their funds, because you want to get comfortable with their investment process, right? Because whatever deals they'll be surfacing to you, you want to be comfortable with their judgment. And vice versa. They need to understand your process and what you're really looking for and what your objectives and constraints are. And then the most important thing I would say, though, is be very careful with avoiding negative selection, because, sure, markets are changing a little bit, but the truth is there's still a lot of capital for the best companies, which is where you want to be investing in, right? Yeah. And so all else being equal, most founders would probably prefer capital from high brand, top tier VC firms that everybody else knows, that gives them more validation, except in the cases where there could be strategic value add. And so this is really where, we spend a lot of time with our LPs kind of understanding how they would like to be involved with portfolio companies. What is that specific value they can provide? And, it can range from, one of our LPs is NYGiki. She's the founder of 23andMe. Of course, every digital health company would love to have her on the cap table. But then in other cases where, let's say, the principal of the family office may want to remain anonymous, or, they might be not as high brand names, it sort of becomes more detailed, where, one of the companies recently, which was a platform to connect warehouse workers with employers and simplify that process for both sides. It was a super hot round, and, they were way oversubscribed. And one of our LPs really wanted to talk to them because so happens their family office owns 2 large industrial businesses. And so from the very beginning, they were able to say, we would actually love to use this technology, or at least try it out for all of our businesses. And so, of course, this is the kind of introduction that the founder would take. And if you see that kind of deal that relates to the specific expertise that you might have in certain sectors or to some of your other operating businesses, then there's probably a good reason that you're seeing that deal versus, thinking about a situation where, what does this mean? Like, why am I seeing this first versus maybe some of the bigger, larger investors with structured programs. But I do think that focusing on high conviction opportunities could be a great way to add returns to the portfolio. And earlier, I think it was Dana who said diversification is key. I know many people think about these direct investing opportunities as really doubling down on winners, but the reality is venture, technology, private market space, there's still a lot of risk. So you want to think about diversification of that portfolio and also how it all works in the context of your broader portfolio, which I think sometimes might not be super straightforward.
Wonderful, thank you. And the last question, kind of parting words of wisdom. You look at so many opportunities every single day. What are the common themes that, what are the common themes that you notice? So when you're evaluating deals all day long and you look at all these pitch books and you talk to all of these people, is there anything that stands true across every single idea that you evaluate, or business model, company, pitch?
Well, we're very focused, so we don't get all those different opportunities. I mean, it really is enterprise SaaS and data analytics and all enterprise type solutions. So it's more of there's a ready solution that we look at. So it's nothing really new.
Right, but as you're looking at a number of them, right, in those sectors, right, you obviously you don't invest in every single one that you see. So what are the common themes across the ones that you select, other than profitability, which we
customers. I mean, my number one is how many customers do you have? That's my starting point.
Yeah, and I mean, just to add on, we come in pretty early. So of course, I think the idea itself has to be very unique, but we're kind of betting, very heavy on the founder. So I think their kind of personal experience, I mean, their experience, their relevant experience, their team, their advisors, how they're going to build this idea out. What is their actual moat, right? And entry strategy into kind of building this out is really key when we come in, right? The kind of size of the market, all that thing. And from our perspective, when we're looking at India, it's kind of a B2C play, but when we're looking in the US, we're looking at how do we add value from our B2B network, right? So I think from our perspective, we always look at it as how can we add value each time? Because, just to kind of also loop into the previous question about family offices and direct investments, I think for any investor, whether it be as a fund or as a family office, I think the access to deal flow, proprietary deal flow comes in when you can show value to founders and the ecosystem.
Got it.
The other point I'll add is how do you make money? And what's the
what's the revenue model?
Money? Yeah.
Like, do you already have money? And can you make money going forward?
Of course, yeah.
Well, yeah. How do you do know? How do you make money? It's really key because a lot of these companies don't know how they're going to make money.
You really are not afraid of the rising interest rates, right? At all. I'm just joking. Okay, Olga.
Just maybe a quick addition. Fully agree with everything that Ankita said about early stage. It's really a founder bet. Earlier there was a question about Web3, and I think Marty, you mentioned there aren't that many funds. In fact, there's been a lot of funds in Web3. They just tend to be kind of not brand names yet. But someone recently shared there's been at least 100 of them raised in the last a couple of years, and most of them start at 100 million plus. Now they typically incorporate liquid exposure in them as well. It's not only equity, but that has a lot of impact on sort of companies within the Web3 space, because you really want to be very focused on, is this a real use case, right? Or are we just like putting blockchain crypto hype on something that like never needed to happen? And because there's been so much capital going into Web3 funds, we've met a lot of founders who are getting things funded, which, like, if you looked at that business as a fintech idea, for example, no fintech founder would ever back the market, that is so niche given that size. But simply because they were talking to a different investor base, which just had a lot more capital and kind of a lot more openness to the fact that this can change the world, you sort of see a lot of that. So really going back to the basics. So it's not only the founder, their ability to attract talent and sort of, understand the space, but it's also, is this a real use case? Like, do we really need to be putting houses on blockchain, right? Kind of thing. And so that's just one little addition to that specific sector.
Fantastic. Anything else, Julia?
No, thank you so much. What a great panel.